I am Arti and I'm going to explain financial model created by me on D1.6 CellPower question. Here we can see that the information related to the product in which CellPower solution deals has been provided, and its quantity, purchase quantity, sales quantity, purchase price, sales price, all this information has been provided. Issue share, number of issued shares as well as issue price, it has also been shown here. Now salesperson salary, rent, electricity expenses can also been seen here. Now we can also see that the term loan information is also provided here with its respective bank and the month in which it has been taken, loan has been taken. So all this information can be seen here. And here fixed asset has also been purchased with the respective useful life of asset has been also provided. Now all the loans has been repaid on the date of repayment. Dividend information has also also be seen here. Tax rate, which is 25% on the profit after interest. Now we have to calculate the model for 24 months, so we have calculated it. Now next, which we will calculate it further. So now we can see that in assumption sheet we have shown all the information clearly so that we can use it further for referencing. Now in fixed FAR we have shown all the information related to fixed asset. In fixed asset balances we can see that all the information related to fixed asset can be seen. Here we can see that in month 1 van has been purchased, as well as in month 4 furniture has been purchased. Disposal can also be seen clearly in month 20, furniture has been disposed. So this effect can also be seen in the closing balance. How we have calculated our closing balance? We have calculated it by adding opening balance with purchases and deducted the disposal amount, so that we can get the closing balance of the fixed asset. Now next is our depreciation, in which we have calculated the closing balance of the depreciation. How we have calculated it? We have added opening balance with depreciation and deducted accumulated depreciation on disposal to get the closing balance. Depreciation for the month has been calculated by dividing the fixed asset amount with useful life of asset. Now next, which we can see that calc 1 sheet, in which we have shown purchase quantity and sales quantity of the respective product. Now sales and cost, we have used the calc 1 information, and we have multiplied sales quantity with sales price by referencing assumption sheet, so that we can get the sales in rupees. Cost of goods sold is calculated by sales quantity into cost. Now next, other cost has shown with the reference of the assumption sheet. Next is which we can see that we have calculated our total cost, and how we have calculated, we have added our cost of goods sold with other costs. Now depreciation can be seen from the reference with the depreciation sheet, which we have calculated before. Profit before interest has been calculated by deducting sales with the total cost and depreciation. Now next, interest expenses. So how interest expenses has been calculated from the loans and interest sheet, which we have created our loans and interest sheet, where we have shown all the information related to loans. As we can see that month 2 is the opening balance. Month 2 opening balance, how it is shown from the closing balance of the month 1. So you all know that the closing balance of the month 1 is the opening balance of the month 2. Loan taken can be seen here. In month 1 loan has been taken from SBI, and month 3 loan has been taken from ICICI, and loan has been repaid for the SBI on month 13. So the effect can be also seen in closing balance. It has become 0. Now we have calculated our closing balance, added loans with loan taken, and subtracted loan repaid to get the closing balance. Now interest paid, we can see that interest paid is calculated by multiplying closing balance with the respective interest rate, divided it by 12. So respective interest rate references with the assumption sheet, where we have shown the information related to it. And stock, we can see that we have calculated our stock. So as we can see that loan interest we have calculated our interest paid amount. So we have referenced this in the sales and cost interest expenses here, and after that we have calculated our profit after interest. So we have deducted profit before interest with interest expenses, and then we have calculated tax expenses by multiplying with tax rate, and then profit after tax can be calculated by deducting profit after interest with tax expenses. So, and in purchases we have calculated our purchases in rupees. How we have calculated purchase in quantity with purchase price, and then payment made. Every third month, so we have calculated in that way only, that every third month purchase payment has been done, and because of which our outstanding payment for purchases is shown like this. We have deducted payment made for purchases with purchases, so to get the outstanding payment for purchases. Collections can be calculated. You can see that sales to different parties has been shown from the reference to the sales and cost, and collections, which is done after 1 month, and cash to be collected has been calculated by deducting sales to different parties with collections. And now we have calculated the capital sheet. In capital sheet we have shown that issue price and number of shares, so in their respective month, and in month 16 also issue price and number of shares has been shown. Shares capital issued can be seen here. We have multiplied it with the issue price with number of shares to get the share capital issued, and then we have shown the dividend per share. Dividend per shares has been shown with the reference, and then dividend in rupees is shown with dividend per share, multiplying dividend per share with closing number of shares. Now next we have shown you as that loan and interest, how it has been calculated. Stock, in we can see that the opening stock as well as change in stock. How we have calculated change in stock? We have deducted sales with purchases, and then we got the closing stock by adding opening stock with change in stock, and then closing stock in rupees has been calculated by multiplying closing stock quantity with cost. And in cash details we can see that in cash details we have put all the references with collections from customers through the collections, cash from loans and interest reference has been provided, cash received for equity share capital reference has been given from the capital sheet. So all this we have calculated before, and because of which we are able to calculate total inflow. And then cash outflow has been calculated by referencing it with the payment for fixed asset purchases, payment for purchases as reference with the purchase sheet, payment for other cost reference with sales and cost. Now loan repaid can be seen from the loan and interest. We have calculated here loan repaid, loan and interest. Okay, now next you can see that interest paid is loan interest B31, dividend paid has been referenced with the capital, and tax paid has been calculated in that way only, in which we have calculated sales and cost. So we have total our cash outflow and then deducted it with inflow to get the net cash for the outflow, and then we were able to see our closing balance of cash in hand, which we have shown in the balances. In cash in hand we have shown fixed asset also by deducting fixed asset closing balance with depreciation, and the stock can be seen from the references with stock. Cash to be collected from the collection sheet reference has been given. In that way total asset has been calculated, and the liabilities has also been calculated by adding term loans and payment outstanding for purchases, and then differences have been calculated by deducting total asset minus total liability. And equity share capital is shown with the reference to the equity, okay, so capital. And then we have calculated accumulated profit, in which profit for the month has been shown from the reference to the sales and cost, and dividend paid in the month also is shown. So in accumulated profit, how we have calculated our closing our accumulated profit, we have added opening profit with profit for the month and deducted dividend paid in the month to get the accumulated profit. And then total equity and accumulated profit, we have added equity and accumulated profit to get it, and after that we have deducted total our total asset with total liability to get this difference, which is 0. So as we can see, as we know that what is loan? Loan is a sum of money that one or more individual or companies borrow from bank or other financial institutions so as to financially manage planned or unplanned events. And capital is typically cash or liquid asset being held or obtained for expenditures. So in that way loans and interest are calculated. Capital information can also be seen here, so it is calculated properly too, and it is manageable also. We can show the information with respect to respective months. If in month 19 if a issue has been done, so we can show here, and the respective changes will be shown here, and as well as in the balances and cash details too. So all this for CellPower question. Thank you so much.